Good afternoon. Welcome to our first session of the Make More Manufacturing webinar series. Please mute your line whenever you're not speaking. This will prevent background noise from disrupting the meeting and ensure the best sound quality during the webinar. Today's presentation is provided by our friends at Kaufman Rossin. Kaufman Rossin has been a supporter of the Make More Manufacturing initiative for several years now. During the presentation, if you have a question, please feel free to use the chat to do so. Now, to test the chat feature, if your company is affiliated to a manufacturers association, please type in the chat what association you're a member of. By the way, I'm Zoraida Velasco. I'm Executive Vice President at Florida Makes. You'll see now on the map on your screen the different associations across the state. If you're affiliated with one, please let us know so in the chat. If you're not and are interested in learning more about it, please email us at events@floridamakes.com. Florida Makes is a manufacturing extension partnership for the state of Florida, MEP for short. MEP is a program managed by the National Institute of Standards and Technology, an agency of the U.S. Department of Commerce. We deliver business growth, talent development, and technology adoption services to manufacturers across the state. Our bottom line is to grow and retain manufacturers in the US, and we manage the program for the state of Florida. And we do so by delivering those services through our partnerships across the state with the regional manufacturers associations. I'd like now to introduce Louis Guay and Lindsay Kaiser, who will be facilitating the conversation today. Louis Guay is a chairman of the board, Canada-Florida Chamber of Commerce for Kaufman Rossin. Louis manages a multidisciplinary team of engineers, accountants, and tax specialists. His expertise includes the federal credit for increasing research activities of Internal Revenue Code Section 41, as well as the treatment of research and experimental expenditures of IRC Section 174. As the leader of the firm's cost segregation practice, Louis also helps clients accelerate depreciation on their real estate investments to provide significant tax saving opportunities for real estate developers and investors constructing, renovating, or buying commercial real estate. Lindsay is the manager for credits and incentives. Lindsay has over 8 years of experience as a tax professional. She leverages her experience to help clients solve their most complex tax challenges and identify tax planning opportunities. Thank you both for being here. Louis, I'll let you take it from here.
This is just a recap of the services that we provide under this practice, which I lead here at Kaufman Rossin with the assistance of Lindsay. So R&D tax credits, which we're going to talk about today in more depth. Research and experimental expenditures of IRC Section 174. We put that there. It's probably something you've heard about. We'll cover it a little bit later in this program. It's not the topic of today's presentation, but it goes hand in hand with the R&D tax credit. And you might have heard from your CPA or tax specialist that there's a major change that kicks in for tax year starting January 1st, 2022. Moving forward, R&D expenditures will have to be capitalized and amortized instead of being deducted in the year that they're incurred. So we're going to talk about that towards the end of the presentation, but that's another type of analysis that we provided at Kaufman Rossin, which is, again, goes hand in hand with the R&D tax credit, but can be done on its own or can be done as a complementary to your R&D tax credit analysis. We also work with the Employee Retention Tax Credit, ERTC, which relates to COVID and the retention of employees throughout the pandemic. Credit was available in 2020 and 2021. It is still available on amending tax returns. There are different tests. The main one is a revenue decline by quarters. I strongly encourage you, if you haven't done this analysis, to look into it. It's a very, very valuable credit. It's if you haven't looked into the depth of it, if you haven't really tested it, please do so, because you might be eligible for a credit north of $6,000 per employee, and we provide these complementary analysis for you guys if you want to run the test and see do I qualify or not. This is something that we do within our practice. And it's something definitely, if you haven't looked into that, I encourage you to look into. It's just like the R&D credit, it's often overlooked. We also provide cost segregation services. So we have within the team civil engineers who specializes in figuring out how to accelerate depreciation on real estate assets. So if you buy a warehouse, if you buy a manufacturing plant, if you buy a new office space, most of the time, if you do not perform a cost segregation, you're going to be depreciating your assets over 39 years. Whereas there is bonus depreciation right now available to accelerate some of this depreciation in the current year. So that's something that we also do. And lastly, energy tax incentives, which are becoming more and more popular with the recent tax reform by the Biden administration, or the Inflation Reduction Act. So something to also consider. We work with all industries, and today, of course, our focus is on manufacturing. Next slide, Lindsay. And from there, we're going to get into the program of today with the R&D tax credit, and I'll turn it over to Lindsay to get this show started. Lindsay?
Hi. Yes, as Louis mentioned, and as Zoraida mentioned, I am Lindsay Kaiser, and I am a manager in our credits and incentives practice at Kaufman Rossin. Louis mentioned the ERTC, so I'll just give it one more plug. Please contact me or contact Louis if you think you might be able to get it. It's really, really lucrative. It can be up to $26,000 per employee, so it is huge, and it's definitely something to explore if you haven't explored it yet. So now that I've plugged that, I'll get on to R&D tax credits. So today, I'll be giving a quick overview of the R&D tax credit, which is also known as the research credit. It's more formally known as the credit for increasing research activities and is defined in the Internal Revenue Code under Section 41. That section is one of the most complicated sections of the Internal Revenue Code, and there's definitely a lot to that code and the R&D tax credit. So it's not something that you will want to calculate yourself. It's something that you would want to hire someone to calculate, so we can certainly help with that. The credit was first enacted in 1981, and in 2015, it became permanent. It's a federal tax incentive for businesses to increase their research and development. So in the 1980s, a lot of these types of jobs were starting to be put offshore, and essentially this credit was created to help incentivize keeping these jobs onshore. So what this means is that any R&D activities that are included in the credit must be activities that are conducted within the US. So I just wanted to mention that. The credit is a dollar-for-dollar offset against federal income tax liability, and certain state credits are also available. One state credit I'll mention is Georgia. They have the ability to take that credit against payroll taxes, so that's a great state credit there. California has a great credit, and there's a few other states that have really lucrative credits. So I just wanted to mention those. The research credit is calculated based on qualified research expenses. These are known as QREs. That's basically what we abbreviate those as. And these are incurred during the conduct of qualified research activities. Those qualified research activities are called QRAs. That's our abbreviation for those activities. So essentially, there are certain types of expenses and activities that are includable in the credit. So essentially, you must be conducting certain types of activities, and essentially we would include certain expenses within your range of expenses that you have in total. The qualified research activities that we can include in the credit aren't just limited to work done by scientists or engineers, for example. It's not just lab work and those types of activities, but there's a lot more that it encompasses. And a taxpayer does not need to have a specified R&D department to qualify. So various activities conducted by manufacturers, such as improving products or processes, can qualify for the credit. So a lot of these activities that you may be conducting already, and often we find that taxpayers are conducting already, can be included in the credit. Depending on the context and the calculation methodology, the net benefit of the credit is typically between 6 to 10 cents on the dollar per qualified research expense in any given tax year. So essentially, if you spend $1, you can expect to get 6 to 10 cents back in credit. I'm going to go to the next slide. All right, so if you don't have income tax to use the credit against, you can actually carry that credit backward 1 year and forward 20 years. So even if you don't have any income tax due in the current year, the credit can still be an advantage. If you plan to have income, which we all plan to have income at some point, typically, right? Then that credit can be used in later years to offset income. I also wanted to mention that the credit can be used by certain small businesses to offset payroll taxes. So certain requirements must be met for a taxpayer to be eligible to use the credit to offset those payroll taxes. Here, there are essentially more requirements to be able to use the credit against payroll taxes than to use it against income taxes. But if you are eligible, this can be great because, again, if you don't have any tax liability yet, then you may be able to use this against payroll taxes still. The credit amount that can be used against payroll taxes is up to $250,000 per year currently, so it's pretty large, and it will be up to $500,000 per year for tax years beginning after December 31st, 2022. So essentially, recently, what they've done is they have increased this and made it larger, so it's even more lucrative now than it was in the past, or it will be starting after December 31st of 2022. In order for a business to be eligible to take the credit against payroll taxes, gross receipts of less than $5 million, there must be gross receipts of less than $5 million for the year the credit's being taken. So that's one item. The gross receipts have to be somewhat low, and no gross receipts, you cannot have any gross receipts before the 5-year period ending with the tax year that's in question. So essentially, if we're speaking about a tax year that began on January 1st of 2022, that would mean there could be no gross receipts before 2018 if you are a typical calendar year filer. And this credit can be used against payroll taxes for a maximum of 5 years. Now that we've discussed those items and how you can use the credit, I'd like to just discuss what types of items and activities can qualify for the credit. So qualified research can occur almost anywhere there is a tangible product, software, or transformation process. Qualified research activities, or QRAs, as we call them, include a variety of activities that many taxpayers conduct in order to remain innovative and competitive. So as I mentioned before, many activities you're already conducting may be considered to be QRAs and may be includable in the credit. Each project that's included in the credit must meet the definition of what's considered to be qualified research. So I'd just like to go through what that includes. So each project must include these items. You must be attempting to develop or improve functionality, performance, reliability, or quality of a product, process, software, technique, invention, or formula. So essentially what you have to be doing here is making something better, faster, stronger. You're improving it in some way, you're making it, you're making it faster or perform better or be more reliable, whatever it is. Then the second item is that you must have technical uncertainty at the outset of the project that's being worked on. This could be not being sure of the capability or methodology for the development or improvement of the product or process or whatever it is that's being worked on, or its appropriate design. So here you're not sure if something's going to work, or you could be sure that it's going to work, but you don't know how you're going to make it work. The next item is that you must use a process of experimentation to eliminate that uncertainty. So here you're evaluating one or more alternatives or hypotheses through testing or modeling or those sorts of items. And then the last item is that process of experimentation I mentioned must rely on hard sciences. So again, those projects must include these items. To give some examples of activities that are includable in the credit, I'd just like to mention those. One of them is development of new products. Another is improving existing products. So it doesn't have to be that you're creating something new. It can be that you're just improving upon something that you've already created. Another is improving manufacturing processes. If you're trying to essentially cut costs or something of the like, then we can include that as well. Another item is automation. That's a big one currently. A lot of companies are trying to automate a lot of their work, and we can include automation activities. Another is changes in raw materials. Packaging is another one. That's one that you might not think of, but that we can include. And there's many other activities that we can include as well, but those are just some general examples that I can give you. Next, I wanted to discuss the types of expenses that are applicable to the credit. So these are those qualified research expenses or those QREs that I mentioned earlier. The first one I'd like to mention is wages. So for personnel involved with qualifying projects, this would be including direct supervision or support of development work. So if someone's involved in those development activities, even if they're in those support or supervision roles, we can include their time spent on those development activities, and we would include their taxable wages or their W-2 Box 1 wages. And essentially, we would multiply those out by the percentage of time that they spent on development activities for the year in question. The next item is supplies expenses. So these are materials used in the conduct of qualified research, such as raw materials or parts used in prototypes, and they must be non-depreciable in the hands of the taxpayer. The next item is contract research expenses. These are expenses paid to US-based third parties to do development work. I will mention here that 65% of those costs paid to those contractors can be included in the credit rather than 100%. It's 65% essentially because the thought is that you would pay those contractors less than you might pay, more than you might pay someone who works for you full-time to do the same job. Work outside the US cannot be included in the credit. That's something I mentioned earlier. This credit was created to keep jobs in the US. So essentially they don't want you to include expenses for work completed outside of the US. Now I'd like to discuss how the calculation actually works. There's two different ways to calculate the credit. One of them is using the ASC method, that's the alternative simplified credit method, and the other is using the regular method. So under the ASC method, you would take your current year qualified research expenses and then subtract out 50% of the average qualified research expenses of the prior 3 years and multiply that by 14%. So essentially here, what we're doing is we are comparing our current year expenses related to development activities to the prior 3-year expenses. And essentially, the more you increase your research activities, the higher your credit will be year over year. But if you keep your research activities the same year to year, you will still get a credit. It just won't be quite as high as it would be if you increase those activities year to year. The ASC method is used more frequently. The regular method is based on both QREs and gross receipts from prior years, rather than just being based on those QREs or qualified research expenses as the ASC method is. So basically, you're also pulling in those gross receipts when you use that regular credit calculation computation. And the regular credit is used more often for startups and newer companies that haven't been in business as long, or companies that do not have as many gross receipts as some of the companies who use the ASC method. So that covers what I wanted to discuss today, and I'm going to turn it back over to Louis from here.
Thank you, Lindsay. So I guess, and before moving on, and hopefully you grasp that this is value added. I mean, this is not a matter of compliance. This is this is a tax credit that can be utilized against a tax liability. So if you pursue the R&D tax credit, normally you're gonna get a benefit out of it in reducing a tax liability, or even using it against payroll taxes, as Lindsay mentioned, depending on the on your circumstances. So what I want to talk about for the next couple of minutes before we open up to questions is really about R&D tax credits in the context of manufacturing. And we titled this presentation, I think, an often overlooked tax incentive, often overlooked by manufacturers. And, you know, looking at the industry more and more, when we talk about R&D tax, we think about technology. You know, we think about the new cool gadgets or the new cool technology, the augmented reality, the metaverse, crypto, even if it's not going so well these days, but all that, you know, all that stuff is usually where, you know, the first reflex is to think that this is where R&D is, and manufacturing has been around for much longer. It's not maybe the flavor of our times, but you know, personally, I'd rather sit all day and look at the jaw crusher crushing rocks than sitting in the metaverse. So that's why I get so excited when we have a chance to work with manufacturers. Again, no disrespect to our technology clients, but there's something about manufacturing, I guess, maybe from my roots that really which I really connect to, and the idea is that we believe that manufacturers often overlook the extent of where they conduct R&D. And the slide that you see, and please disregard I'm not trying to advertise for this particular company. It's just something I picked from internet. But what I want to show is, as you see, it's a bag of cement, and it's a cement plant. Is, you know, years and years of R&D, and often what I hear when we talk with manufacturers is that, well, we've been around for so long, we've never claimed R&D. Our process is well established. Our product is the same that it was 50 years ago. And I like to give them the example of cement, because I worked in the cement industry. I've claimed R&D tax credits in the cement industry, millions and millions of dollars. And, you know, Portland cement, as we know it, which is the main cement, as it was invented in 1824. The industrial process to manufacture cement goes back to the early 1900s. So if we are 120 years later and we still have R&D in that particular industry, I'd like to think that, you know, most manufacturers have activities that can potentially qualify for the R&D tax credit. And we'll see in a couple of slides, you know, we classify certain activities, and we want to give you specific examples of what is often overlooked. But I think I go back to the cement industry, and again, you'd say that the cement powder itself is relatively simple. You know, it's a limestone that you mine, that you calcine and you grind, and then you get that powder. You mix it with water and aggregates, and then you have concrete. So but still, you know, the product itself evolved over the last 100 years because of different triggers. You know, either, you know, changes in raw materials, materials that are more scarce, that are more difficult to source. Changes in regulations can also be a big trigger of R&D. You know, environmental, you know, the carbon footprint reduction that is more and more out there as forced, you know, in the cement industry to reinvent its process. So maybe the core of the process itself hasn't necessarily changed. The process, the concepts are the same, but the cement industry throughout the years had to reinvent how they manufacture cement, had to come up with new formulations that are more eco-friendly, if you want, and all of that is often overlooked by manufacturers. The fact that this is not necessarily the development of a new product, this is not necessarily revolutionary, but small changes, small things, changing in your industry can potentially lead to R&D projects. You may not label them as R&D in your business, and they may not be conducted by R&D engineers or scientists, but that doesn't exclude them from potentially qualifying for as R&D under the tax code. It's also important to understand that R&D from a more like traditional definition is considered to be conducted in a lab by scientists in white coats, but R&D for tax purposes has a much broader scope. And just so you know, there is judicial guidance out there that shows that the tax code, the definition of R&D under the tax code intended to include R&D conducted in a commercial/manufacturing environment. There's a court case called Union Carbide, which was a big case. I'd like to say maybe 10 or 15 years ago, maybe even more, like 2002. And it was not necessarily a win on all aspects for the taxpayers, but in there, the court acknowledged that R&D can be conducted in a full-scale manufacturing plant on a full-scale commercial process that is running and manufacturing products or goods. So you don't have to be in a lab environment to conduct R&D. Lindsay, you can go to the next slide. And from cement, I'm transitioning, I guess, to you see a box of pasta and bacon, but it's a story I like to tell. A couple of years ago, I worked with a box manufacturer, manufacturing, the box itself, from preparing and forming the cardboard to all printing, activities. And until I met with them and until I met with their engineers, toured the plant, and really got to understand, I had never thought that a box can be so complicated. And I like to give this example because I think, again, we're talking about something that you would never really think about the complexity that behind that pasta box when you work in Publix or in your favorite grocery store. But and that story goes back several years ago. But I remember I was explained that one day somebody in marketing had the brilliant idea that you wanted to see the product in the box. So you want to be able to show that little window so that the customer can see the pasta. And itself, it looks like simple. It's just cutting a hole, putting a film there, and voila. But these boxes get manufactured and printed at very high speed, and just the simple need for this hole, and then applying a film and finding the right glue to make it stick at a very high speed again was in itself involved a lot of R&D and a lot of trials and a lot of back and forth. And this was developed multiple years ago, and then came in the wave of, okay, well, we need now to have an eco-friendly box. We need recycled cardboard. And just from there, suddenly the process doesn't work anymore because the recycled cardboard doesn't behave the same way. The fiber on top don't necessarily react the same way with the glue, and then the film doesn't glue itself. So having to again reinvent your process completely, redevelop, conduct series of trial, work with different raw materials, that triggered another cycle of R&D. So, and again, you would not necessarily think about all of that when you just look at that box. And similar story that I was told about is, again, the bacon board, with a requirement to have very shiny, very nice colors on it, and the fact that you have some a very greasy product that's going to be laid on it, and that can potentially affect how the ink is gonna stay on the board itself. So years of R&D and improvements behind something that appear very simple when you look at it. So again, I think sometimes manufacturers have the reflexive thinking that because they are in control of their process, they are in control of the product, that what they do is simple, but it's not so simple after all when you take a step back and look at all the efforts that have been that are involved in developing products and processes. And we can go to the next slide.
Hey, Luis,
Yes.
this is Chris Esteves with Tucci. On your box example, is a tax credit allowable if we hire consultants to look at our process, look at our boxing, make design changes to our if it results in a complete change in our packaging system?
Yeah, the answer again, yes and no. I mean, yes, contractors can be included in the R&D calculation, like Lindsay said, 65% of the contractor costs, if it's US based, can potentially be included. Where you would have to show that this consultant is part of that process of experimentation, that you are looking at alternatives, you are looking at new ways of making things with that consultant. And then you are testing some of these alternatives that are identified with the contractors. So potentially, yes, has to be a U.S.-based consultant. So again, it's case by case, but potentially yes. Lindsay, I don't know if you wanted to add something.
Yeah, I think all of that makes sense. And I agreed, it's a potential yes. There's certain items that we would have to look into, but it could be something that could be includable. There's a lot to it, as I mentioned. It's a very complicated section of the code, section 41. So there are certain items we have to look into, and there are certain issues with who has rights and certain items there, but it's something that we could definitely look into and possibly take. And Louis, there is one more question. We have a question from Kate Lane. She asked about one item. The Department of Defense implemented changes to contractors/subcontractors contact regarding compliance to protect critical information, CUI. The implementation of CMCC, would the cost incurred to become compliant be an improved process?
Well, again, the legal costs or the cost of meeting regulation per se, no. It's all the costs around changing your process or getting your process to be compliant that would potentially be eligible. But if it's a matter of more of legal, or if it's a matter of interpreting the regulations and so on, no. But anything done physically to say, all right, we need to change how we manufacture a specific item, potentially that could be a trigger for R&D, yes. Now, when you're a subcontractor, when you're working with, the question was about the Department of Defense, there's also another aspect we didn't touch in today because it gets more technical, and we didn't want to get into granular detail. But if you are performing R&D on behalf of someone, there's a matter of what we call funded research. And if you are getting paid to conduct R&D, there's a test that has to be satisfied to show that, first of all, you are at risk, financially speaking, for conducting that R&D, meaning that if you work on a time and material contract where you're getting paid for all the hours spent, and that you can go, as high as you need to, and you'll be compensated, you're not going to satisfy that test. Technically, in general, you have to be under a lump sum agreement. Whereas if you bust, you bust, and you're responsible for having to incur the additional cost to deliver the product to your client. The second requirement is that you have to own, to have substantial rights into the outcome of the research. It doesn't mean you have to have exclusive rights, but you have to be able to reuse what you learn as part of the development process and the concepts that you develop. You have to be able to use them for other clients or for your own operations. If you have to turn over the entire rights to whatever was done, you're not going to be allowed to claim the R&D credit. So you need to satisfy those two requirements. Sometimes when you work with very, very large OEMs, or it's a little bit difficult because those contracts state that pretty much the air that you breathe, they own it. But I mean, it's something that needs to be looked into. So if you are doing R&D on behalf of someone else or as part of a contractual agreement, the contract itself has to be looked into to make sure that you qualify. You both cannot claim the credit. If your client claims a credit, technically you shouldn't be claiming the credit. It's one or the other. or in certain cases, it can actually be no one because of how the contract is structured.
Yeah, and there are clients that we've worked with wherein we have to basically take a look at all of the various contracts that they have with their different clients and then basically figure out which projects we can include and cannot include based on those rights and risks. So that's something that we have experience with and have had to do many times.
And sometimes one way around that, or the way to look at it, is more look at it from the process perspective. You know, you own your process. You're not turning over your process to your client. So if the finished good has been developed under a contractual agreement that and we find out that you do not actually have the rights, or you are not at risk, we can look at it from a perspective of, okay, what did you develop in terms of process? How did you come up with the way of making that product, and that is yours. And potentially the credit can be claimed around the process itself rather than the product. Now that changes a little bit the type of, the amount of expenses that you can include. When we work on a process, technically we cannot include cost of supplies used in the prototype or in the trial, but still all the engineering, all the time spent in developing that or improving that process can potentially be included. My advice here is, again, don't shy away from exploring if you qualify for the R&D credit because you do your R&D under contractual agreement. But take the time to look into it, and let's look at the terms and make sure that, yes or no, you qualify, but don't shy away from it because it's done under contract. Moving on with the presentation, and we'll be more than happy to take more questions. We have 2 or 3 more slides. So here, and I don't want to read the entire slide, but I think it's important, and it's there also to give you ideas as you're listening to this presentation. Is, we classified the type of activities that we see, the R&D activities that we typically see in manufacturing in 3 buckets. The low-hanging fruit, which is the R&D that that you're conducting, that you don't necessarily need the R&D tax specialist to guide you through, is your laboratory type of activities. If you have a lab and you have some scientists, or you have people that are dedicated to developing new products and replicating your process in a small controlled environment, I mean, typically this is going to be pretty clear that it qualifies, and not necessarily the type of activity that will be contested. So the wages for, if you have a core R&D team, a core new product development team, I mean, this is usually, that is an easy thing to go after. The second category, which I'll call often overlooked, so some more like experienced manufacturers or people that have done R&D for years will know to look, but some might overlook improvement of existing products. Because the product has been around for 20 years doesn't mean that you're not still improving. It doesn't mean that you're not changing the functionality. It doesn't mean that you're not improving the quality. It doesn't mean that you're not improving the reliability. There might have been some changes, again, like I said, in regulations that require you to change how the product looks and how it's assembled, how it's built, its main functionality. You may try to add functionality to an existing product. So because the product is out there, doesn't mean that it's not R&D. If you're improving a product, you're kind of developing the new product in itself. That the improved product becomes the new product. Developing new manufacturing processes. Again, people sometimes forget about the process. The processes in manufacturing is critical. It's not just the end product. It's not just the tangible good that come out of it. It's the process itself. So all the time spent developing a process, improving its performance, refining its stability, that can lead to R&D projects. So in terms of expenses, often overlooked, the wages for production and quality teams involved in qualifying R&D projects. Again, the R&D team itself, the new product development itself is a low-hanging fruit, but sometimes you'll forget about the fact that your production and your quality teams are involved to a certain extent in those projects. Maybe not 100% of their time, but a portion of their time is on an annual basis is likely dedicated to assisting with the development of new products or processes. And the cost of raw material used in prototypes. So one thing that I want to mention here is, and again, this is often overlooked, is that if you are building a first of a kind piece of equipment or a tangible good, if you're building a new, let's call it like an automation equipment for a client based on specifications that have never been done before, even if you end up selling that piece of equipment, even if you sell the output of your process, if you're conducting R&D on that particular piece of equipment or that tangible good, and that you need to build a prototype, or you need to run the trial to eliminate the uncertainties that you're facing, to figure out if you're able to achieve that new product or that new piece of equipment, you can still include those parts and those supplies in your R&D expenses and claim the credit on it, even if you end up selling the output of your R&D. And that's something that people sometimes kind of don't necessarily think of, because they think, oh, well, we sold the product at the end, so we cannot claim the raw materials. But if you needed to build that prototype for an R&D purposes, you are allowed to include those materials. And lastly, and regularly ignored, improving manufacturing process performance. Again, process has been around for 20 years. People sometimes don't think that, the work spent on improving speed, improving stability, allowing the process to work with different raw materials. All of that are improvements that can potentially qualify for the R&D credit. Lindsay mentioned automation earlier. That's another important one. If you had a process that was highly manual and that you're transitioning towards a more automated process, there is a potential there also for R&D tax credits. Introduction of new technologies, the trial that you run on those production lines. So if you are developing a new product, you do your proof of concept, you work in your lab, and then you're ready to go, and you say, all right, let's run like a batch on a production line. And often whatever you accomplish in the lab is not necessarily always representative of what's going to happen in your full-scale process. The conditions, the environment is not as controlled in the lab. You have to run this couple of batches to make sure that your product meets the requirements or meets the specifications you're trying to accomplish. And as we know, especially in heavy manufacturing, you cannot just run one or two products on your line and say, all right, well, we're good to go. You often have to go through a couple of hours of trialing and enough output to feel confident that what you developed or what you improved can be replicated on over a long period of time, and it's not just a fluke after one or two products. So these trials, they can be very, very valuable. And again, like I said earlier, even if you sell the output, you can potentially include in your R&D credit the supplies and the wages of the production employees that are running the trials. And going through the list, because I see time flying by, I thought we would have plenty of time, but as always, we underestimate, our passion for the topic. So development triggered by cost reduction initiatives, change in specification and product outputs, trials associated with change in raw material. We talked about that. Another thing to consider, the cost of special tool jigs used in the development or improvement of products. Those can also be potentially included. And I know that those can be very expensive. So something to keep in mind. Software development to support production activities, the development of environmentally friendly packaging, and anything related to environmental reduction of carbon footprint. That applies more if you have like a process that involves emissions. We're not necessarily here talking about putting a program in place to recycle in your cafeteria. It really has to go with your process. And Lindsay, we can move to the next slide.
Sure. And Louis, before we do, when you're mentioning software development, actually, Jacob Rubenstein had a question. His question is, if the company is a software developer, do all products developed qualify for R&D? So if we can just take that one and discuss that a little bit.
So software development in itself can qualify for the R&D credit. Yes, if you are developing software for internal use in your administrative processes or general processes, that's a different story. It's going to be considered internal use software. There are additional requirements to be satisfied, and it's not the topic of today's presentation, but there's potential. But If your business is developing software for to be sold or licensed or used as in SaaS service as a software as a service, yes, typically the development of software is an activity that falls under the definition of R&D.
Yeah, and I'll just mention that we have to be careful about making sure we take any maintenance time out. So if something's been developed, but we're now doing maintenance work on it, then we would take that maintenance time out. But we may have some sort of software that's been developed and functionalities being added. It's not something brand new any longer, but we're improving it all the time. Then we can continue to take the R&D tax credit for that work.
Thank you. Real quick, because I want to say a few words on Section 174, and then I want to open up for a question. But you can see there our process in assisting manufacturers with capturing the R&D tax credit. It's a proven and robust process. And again, we always start, even before phase one, the scope. I say we always start with, let's call it like a pre-scoping, where we're going to sit with you. We're going to schedule a call. You call us. You say, hey, I'd like to explore R&D tax credits. I'd like to evaluate, do I qualify first? And then to what extent? We always do that on a complementary basis. So we set up a call with, we'll generally recommend that someone who's familiar with your operations, either an operation manager, or if you have an R&D team or manufacturing manager, somebody that knows what's going on the production floor is there. Somebody from the accounting or financial team. Depending on the size of the client, sometimes the owner or the CEO will sit and we'll just talk about your activities. We'll ask you to describe what you guys are doing. We'll ask several questions, and we'll try to quantify at a high level. Okay, here's how many people we believe qualify. Roughly, they represent X in payroll. We probably have another X, Y, Z in supplies, a couple of contractors. Then Lindsay and I will take this back. We'll run some scenarios, and we'll give you a range in terms of, okay, we believe based on that pre-scoping that we did together that your credit will fall between X and Y. And here is, how we propose to proceed. Here's a fee. We work on a fixed fee. It's not a percentage of your credit. It's really, you know what you're getting in when you work with us. It's a fixed fee that we develop based on our hourly rates at the firm, and how much time we expect that will be needed to put your credit together. Very important before we move on is that as part of that process, there's all the discovery phase of getting the information, finding the information in which you are involved, of course, in helping us find the data point and where to find that information that will help us put the credit together. But then it's a matter of documenting that credit. You want to make sure that what you do is well documented. So it's a lucrative credit. It's just like any other tax incentives. From time to time, the IRS can look into it. You're never really fully protected from an audit, but if it's done correctly, if it's well documented, if you can go back to your work paper and really show who you included, to what extent, what were the projects that you included. It's a project by project basis. It's not lumping everything in just one pool. Say my R&D expenses are X, my credit is Y. No, it has to be broken down by project. When we run the 4-part test that Lindsay talked about earlier on, we look at it on a project by project basis. So at Kaufman Rossin, we pride ourselves in the fact that we put together a very robust deliverable that usually is going to answer all the questions that the IRS would have on their first information request. All those questions are already covered in the information that we put together and supporting your R&D credit. So again, it's not just a matter of preparing the form itself. The form itself, 6765, looks pretty simple when you look at it, but it's really what's behind it and how it's supported. How do we show that we included this amount of wages? Where are these wages coming from? Who are these people? What activities did they conduct? That's what we do in our process. And Lindsay, real quick, let's put the 174. So as I mentioned earlier on, you probably heard right now from your CPA or your tax specialist that starting in 2022, you will have to capitalize and amortize R&D expenditures. Anything done, R&D expenditures within the US over 5 years, and any R&D done abroad 15 years, that hurts. And this is notwithstanding if you claim the R&D credit or not, okay? So people sometimes make the mistake of saying, and Lindsay and I already have been on some of these calls where someone will tell us, well, I'll stop claiming the R&D credit. I'm not claiming the R&D credit anymore. I don't have to worry about this. That's not true. If you have an expenditure that meets the definition of Section 174, any expenditure incurred in developing or improving a product, a process, or a software, you are required now by the new law to capitalize and amortize. Doesn't matter if you take the credit or not. You don't take the credit. If the expense was an R&D expense and you did not capitalize it, you're not respecting the current requirements by the IRS. So, of course, if you're going to have to capitalize and amortize, I recommend let's claim the credit, because the credit is it's a permanent credit. The fact that you have to amortize is more of a timing difference. If this thing stays on, I mean, in 5 years, the pain of it will be gone, because we'll have gone through 5 years of amortizing each year, and we'll be back to our old self. I don't think it's going to stick around. There's still hope that it gets fixed before the end of the year. I can tell you that the National Association of Manufacturers has been all over this. They've been lobbying hard, and we encourage everyone to continue to reach out to their local associations and put pressure on Congress to reverse this thing this requirement, which, by the way, was implemented in it came from the 2017 tax reform, and it was put in there as a revenue raiser so that they can reach the balance that they needed for the other more favorable tax cuts that they pushed back then. And they had put it effective in 2022. And the thinking was, well, we have 5 years to fix it. I mean, obviously, plenty of time. December 13th, yesterday, we just received a revenue procedure about how to proceed with this change in accounting. So it has all the look of something that is not going away. Fingers crossed, maybe through the tax extenders. But we are, informing our clients and telling them, you need to prepare, you need to get ready for this. It's going to have an impact on your taxable income. You used to say, for example, you have $1 million in R&D expenditures. That used to be $1 million deduction. Starting this year, it's actually $100,000 deduction because you have to amortize over 5 years, but it's a mid-year convention. So the reality is it's over 6 years. And it hurts even more if it's done abroad. Like I said, it's over 15 years. And lastly, please note that your R&E, research and experimental expenditures under Section 174 are usually larger than the pool of expenditure that you can include in the R&D tax credit. In the R&D tax credit, we work with taxable wages. In Section 174, you work with fully burdened salaries, including fringes and benefits. And there are type of expenditures that are considered R&E expenditures, but are not includable for the credit calculation. By default, anything you include in your credit calculation is a 174, but on top of that, there are other expenditures, including overhead and indirect supplies that can potentially fall under 174, requiring you to potentially amortize a portion of your lease to account for the fact that there is R&D performed in your building. Highly recommend that you have these discussions with your tax advisors. We are more than happy also to assist. This is something that we've been working on for several months now, preparing for the fact that it's likely happening. But don't think that it's it's going to require some adjustments. So something to keep in your year-end process. So on that note, I thought we would have 15-20 minutes for Q&A, but Lindsay and I are available, and we can stick around, take any questions. And again, thank you very much for this opportunity. Thank you, Florida Makes, and it was a great pleasure to be with you guys today. So I'll turn it over for questions.
Louis, thank you so much. And Lindsay, this was so informative. We appreciate you taking the time, appreciate your passion for the topic and for helping manufacturers. If anybody wants to ask a question verbally instead of through the chat, you're more than welcome to do that. I did want to let everybody know, and based on what you just talked about, advocating with your local elected officials on some of these issues, there is, and I think Patricia is going to share a slide, there is an organization that does just that, aggregates manufacturers and helps with advocating for some of these issues in the legislature, et cetera. It's the Florida Manufacturing and Supply Chain Advocacy Council. So figured I would share that with you. If anybody has questions, I think there's a feature where you can raise your hand or dump that question in the chat Here I have a question from Juan Sebastián López Orejuela. How long does it take to have a tax credit approved?
Well, there's no approval process per se. It's claim on your tax return. So you file your tax return, and you remain within the statute of limitation is 3 years. So if you're not audited within 3 years, technically, they're not going to come back and look into your R&D credit unless they would think something fraudulent was done. But we don't apply with the state. We don't apply with the government. We simply add this to your tax return under Form 6765. At this time, we still do not have to provide supporting documentation. The supporting documentation stays with you. It doesn't go to the IRS. I say at this time because there is more and more traction where we see the IRS starting to look for ways to change that, modify that Form 6765 to ask for additional information, including in the future, maybe some short project descriptions so that they get a feel for, all right, is this legit or not? If you are trying to claim the R&D credit on an amended return, so meaning you filed in the prior year, you didn't claim the R&D credit, now you want to claim it, the year is still open, still within 3 years, there are additional information that starting this year has to be submitted. And that's our feeling in the industry, that if they're starting to request that on amended return, it's potentially something that in the future they will want to ask, and they have already been issuing in certain conferences certain clues suggesting that they'd like maybe to make this form a little bit more exhaustive. But as of now, we only file the numbers on the form, we keep the supporting documentation, and we move on, and that credit is getting applied against your tax liability directly.
Great, Louis. He has 2 follow-up questions from the same person. I'll read them out loud. If you think the answer is too long, maybe we can get the Juan Sebastian's email address and try to answer these separately. But he says, do you have to present an R&D project in your supporting documentation? And then he says, does the project description have a form?
So no, as of now, no. Certain providers will not necessarily, certain R&D prepper will not even look in your projects. We don't recommend it. We the requirements per se, they call it a business component. And a business component, it's a product, it's a process, it's a software. And so technically you want to show in your documentation a breakdown of your R&D expenditures per project. Another reason why is that if you are ever audited, the IRS will look at them again from a project perspective. Maybe they'll be happy with one project. Maybe there's a project that's not as strong, let's say, and you want to be able to show that segregation of your expenditures and not put everything in just one pool. So again, it stays with you. You don't have to disclose it to the IRS. But in the case of an audit, it's going to be one of their first questions. Show me how your R&D expenditures are split between projects. So
Great.
We prefer to go, ahead and do it and have it in our supporting documentation.
Great. I don't know, Lindsay, if you can answer Karen's question in the chat. I want to be respectful. There she is. She was actually already answering it. Good. I appreciate your time. I appreciate Kaufman Rossin's support of the Make More Manufacturing Summit. This was part of their benefits for supporting the conversation we had back in October. And to continue this conversation with manufacturers, we will be having these Make More on the road gatherings throughout the state to bring conversations like this one and valuable information to manufacturers across the state. And so please stay tuned for more conversations like this, more opportunity to learn and support manufacturing across the state. Really appreciate Louis, Lindsay. I see Aaron's on the line from Kaufman Rossin. Thank you for your support, for the work you do for manufacturing and your role in this ecosystem. And with that, we will wish everybody a good afternoon and stay tuned for more events like this in the future.
Thank you very much.
There's somebody, David Guzman has just raised his hand.
Thank you.
Go ahead, David. We've adjourned, but if anybody wants to stay, I don't know if Lindsay and Louis have time to.
Yeah, no, absolutely. Absolutely.
Okay. David, you're muted.
Thank you. That would have not been very helpful. So I realize like this is incredible information. I've never, considered this. I do have a manufacturing company with a lot of different product lines that I've been developing over the years. And, as a, hands-on manufacturer, like I didn't realize this was something available. And I haven't kept like these, so you're saying it's got to be by project and, so a lot of my projects kind of tie into a lot of projects. I don't know how to delineate the project. I don't know how to go back and get my expenses figured out. I feel like I need to arrange with you guys something. And I guess this isn't really a question, but it is a question. How do I start this? I mean, besides telling you guys to come to my office and sitting down, but like when we sit down at the office, I don't want to just come in and then like I have nothing for you. I need to have information. Like what how does this process really start? Because I've never planned for this.
Yeah, it's a good question, and yes, I mean typically we'll get on a call, we'll meet with you, and we'll start a discussion. But I think you mentioned I have a lot of products, a lot of projects. If you can start by, I don't know if they have denominators in common. If there's a couple of buckets instead of having to deal with 100 projects. If there's a couple of products that are in a similar line or for a similar purpose or targeting a specific industry, we look at it from that perspective instead of starting at the very, very granular level. Let's group these projects in sub-projects and try to, evaluate the opportunity in each of these buckets first. And from there, look at it from, there's the two largest type of expenditure. Expenditures are what's going to drive your credit. So wages and supplies. So you said I didn't track anything. I haven't come across one manufacturer yet that necessarily has the perfect tracking system. They don't have time reports, they don't have time sheets. We're just gonna, sit with your team and try to estimate at a high level how many people are involved in that process and to what extent. Is it 50% of the time? Is it 75% of the time? Do I have people that are 100% of the time? No, you can run a quick estimate of your R&D expenditures on an Excel spreadsheet. You list a couple of people or, the type of jobs within the company, and you say, these people account for $1 million in wages. 50% of their time was spent last year developing new product or doing, stuff that qualifies R&D. 50% times their taxable wages, and add all of that together. And generally speaking, for it to make sense, if you get to at least, $400,000, $500,000 of R&D expenditures, you're talking about, credit $30,000, $40,000. At that point, it starts making sense. If it's much more, even better. But, at least try to grasp for roughly how much you have. And from there, that's where we come in and we start a discussion to go in a little bit more depth, see if there is additional type of expenditures that can be added, see if there are other projects beyond the low-hanging fruits, and then we put that together with you.
Okay. Yeah, because I have automation, I have machines that were developed, I have patents, I have labor, I have material. I mean, I have all the things. Like it was like you guys were saying all this stuff that like it was making sense to me, but I just I don't know how to put it all together. And the product lines that I've developed definitely all fall into certain sectors. So my finish line, all of that would go into that finish line. I have a couple different projects, but I have one main line of products that everything else stems from. So I think all my R&D, and this has been a massive thing for us, is we've been investing a lot of money in this line of products. And I just, until I met Aaron and Aaron started talking to me about it, I didn't really understand that there was this opportunity. And I didn't think my company was going to get as big, and I didn't think this product line was going to get as big. And so the cost of it is just continues to grow. I mean, I'm still doing R&D. Like I'm going to walk out of this meeting and go do R&D.
Yeah, absolutely.
So it's just a continuing thing. So I guess I'll get with Aaron. I'll set up a meeting with you guys and we'll go.
Yeah, absolutely. And one thing, one last thing, real quick is because the requirements to claim R&D credit on the amended return have changed, don't file your tax return without your R&D credit. If you plan on claiming your R&D credit, you want to claim the R&D tax credit, you're not done with your study yet, file an extension, file your tax later, file the extension so there's no penalty. But, sometimes people would say, all right, I'll file the tax return, I'll just amend in the future to claim the R&D credit. It's becoming much, much more burdensome to claim R&D on an amended return. So file an extension, give yourself some time to go through the process. The first year is a little bit more challenging. I won't lie to you. We have to establish your R&D basis. We have to go through a longer discovery phase. But once that is done, then it becomes more like a rolling forward process where every year we know what we're dealing with, and it goes a little bit faster. But give yourself some time, because amending for the R&D credit is becoming more difficult.
Well, I'm always late on my taxes anyway, so.
Here you go. Nice meeting you. We'll coordinate something with Aaron.
I look forward to it. I appreciate it. This is really beneficial to my company.
Likewise. Thank you.
Thank you, Louis. Thank you, Lindsay. We'll send the slide deck, if not later this afternoon, early tomorrow, for everyone with their contact information.
Thank you. All right.
Do you have a recording of this?
And there will be a recording as well. So
I'd like to give that to my team.
Great. Well, that'll take a little longer to push out, David, but we'll make sure that it gets socialized.
No problem. I'll bother Aaron. Thank you.
All right, guys.
Have a good afternoon.
Happy holidays. Thank you.